Today, we're breaking down a clear and actionable chart setup for mastering your entry techniques. This strategy gives you two specific ways to enter a trade. The first method is to enter based on candle closure or the very next candle's open. This means you're not trying to predict the move. You're waiting for confirmation. Once you get a significant engulfing candle, you can place a limit order to get in at the 50% retracement level of that engulfing candle's range, aiming for a better price. Your stop loss would then be placed just beyond the opposite end of that engulfing candle. The second, more aggressive technique is to enter based on the break of a key candle. This means you're jumping in as soon as price action cleanly breaches the high or low of a defining candlestick, signaling immediate momentum. Your stop loss for this entry is logically placed on the other side of that broken candle, defining your risk clearly. Both methods emphasize patience and a disciplined, rules-based approach to entering the market. A technical trading strategy for an entry confirmation, focusing on identifying a high-probability buy opportunity after a downtrend. The setup relies on a multi-factor confluence, starting with a trend line break and retest. The price initially breaks above the downward-sloping trend line and then dips back to touch or retest it, turning the former resistance into new support. This retest area is further validated by a 0.618% Fibonacci retracement level, a key price zone where traders anticipate reversals. For the market structure to be considered favorable, the price must exhibit a bullish market structure, suggesting momentum is shifting upwards, e.g., forming higher lows and higher highs. A bullish engulfing candlestick pattern is shown as one potential confirmation at the retest point. To provide the strongest conviction, the image suggests that the entry should be validated by one of three strong bullish reversal candlestick patterns forming at this support level: tweezer bottoms, a morning star, or three soldiers. The confluence of the trendline retest, the Fibonacci level, a positive market structure shift, and a powerful bullish candlestick pattern provides the technical confidence needed to take a long buy entry. Now let's talk about spotting the high probability opportunity that sets up these entries. This is where classic market structure comes into play. We often look for key levels where resistance becomes support. Picture this. The price approaches a significant resistance level, a level where selling pressure has previously overwhelmed buyers. But this time, instead of reversing down, the price breaks through. Once it breaks and retraces, that old resistance level now acts as a new floor. This is our new support. This is the opportunity zone. The chart gives us a perfect example. After the breakout, the price comes back down to test this newly established support level. And right at this critical juncture, we get a confirmation candle, in this case, a hammer candlestick pattern. This hammer, forming right on the support line, signals that the buyers are defending this level aggressively, rejecting the lower prices. This is our trigger. Our entry is then taken, as we just discussed, on the break of that hammer candle or on the next candle's open, with a stop loss placed just below the support level to manage our risk if the setup fails. This powerful combination of a structural level flip and a candlestick confirmation signal is what creates a truly high-quality trading opportunity. Now let's put all these concepts together into a powerful, repeatable setup known as the pivot machine gun, or PMG pattern. This is where our entry techniques and our opportunity zones converge to create a structured trade with a clear roadmap. The pattern is built upon a strong prior trend. Notice the numbered pivots, 1 through 8, which show a clear and sustained price movement. This established trend tells us that the market's momentum is strong and well-defined. The PMG label marks the specific area where the price, after its initial push, pulls back to a key level and consolidates. This consolidation is our signal that the market is catching its breath before the next potential leg up. It's at this precise moment that we apply our entry techniques, entering on the break of the consolidation candle or the next open. Once in the trade, our risk management is crystal clear. A stop loss is placed just below the consolidation zone. For our profit-taking, we have a predefined target 2, which is typically based on a measured move or a subsequent resistance level. This PMG pattern is a fantastic way to systematically identify high-probability continuations within a strong trend, giving you a complete plan from entry to exit. Now let's zoom in and talk about a critical, yet often overlooked detail that can significantly improve your entry quality: the test-performing candle. This isn't a specific pattern, but rather a key characteristic of high-probability breakout candles. The research and data show a powerful insight. Candles with taller upper or lower wicks tend to perform better after a breakout than those with short wicks. Why is that? A long wick represents a fierce battle between buyers and sellers. It shows that price was aggressively rejected from a certain level. A long upper wick signifies that sellers stepped in and pushed the price down from its highs, while a long lower wick means buyers defended a level and forced the price back up. This rejection creates a clearer, more defined level of support or resistance. So, when the market does break away from that level of conflict, the ensuing move often has more conviction and follow-through. This principle holds true regardless of the breakout direction or the overall market condition. So, the next time you're looking for an entry, don't just look for any breakout candle. Look for one that has been thoroughly tested, one with a pronounced wick, as it's statistically more likely to lead to a strong, profitable move. Let's elevate our analysis from single candles to more powerful, high-conviction signals by discussing candlestick pattern combinations. A single signal can be good, but when multiple signals align at a key level, the probability of a successful trade increases dramatically. This slide shows a perfect example of a bearish reversal combo. Imagine the market is in a clear uptrend, but it's approaching a major resistance area. First, we see a bearish engulfing pattern, where a large red candle completely engulfs the body of the previous green candle, indicating that sellers have seized control. But the confirmation doesn't stop there. This bearish engulfing pattern also forms a tweezer top with the preceding candle, meaning both candles share a very similar high. This creates a clear double confirmation of rejection at that exact price level. The message is now undeniable. The uptrend is facing intense pressure and a reversal is highly likely. The chart clearly labels this convergence with a sell signal. This teaches us a vital lesson. Don't trade in isolation. Look for these synergistic combinations, where a pattern like a bearish engulfing aligns with a structural pattern like a tweezer top at a significant resistance level, to find the highest probability, lowest risk entry points the market has to offer. To truly master these patterns, we need to understand the different types of high probability zones where they appear. Not all support and resistance are created equal. Let's talk about the different types of areas to trade. The chart highlights two key concepts: gaps and demand zones. First, look at the gaps. A gap is a clear area on the chart where no trading has occurred, often seen after a strong news event or a weekend open. These gaps act as powerful magnets for price, and they frequently get filled as the market retraces back to them. But more importantly, the edges of these gaps can become significant support or resistance levels. Now, the second and even more crucial concept is the demand zone. The chart shows two types: Demand 1 and Demand 2. A Demand 1 zone is typically a sharp, V-shaped reversal where price rejected a level aggressively and moved away quickly, showing very strong buying pressure. A Demand 2 zone is often a more gradual, consolidated basing area where price built up energy before a strong move upward. Both represent areas where buyers overwhelmingly stepped in. By combining these powerful areas, trading a bullish candlestick combination in a demand zone or a bearish one at the edge of a gap, you are stacking the odds significantly in your favor by aligning your entry with the market's innate memory and imbalance. Ultimately, all the analysis we've discussed, the opportunity zones, the PMG patterns, the candlestick combinations, and the demand areas, all lead to this single, decisive moment, the break. This final chart strips trading down to its purest form. Our job is to identify clear, defined levels and then act when price confirms its direction. We see a series of break of high and break of low signals. A break of high is our green light for a long trade, signaling that buyers are in control and pushing price to new heights, often breaking out of a consolidation or a key resistance level. Conversely, a break of low is our signal for a short trade, indicating that sellers have overwhelmed the buyers and are pushing price to new lows. This is the practical application of everything we've learned. You find your high probability area, be it a demand zone, a flipped resistance level, or the consolidation in a PMG pattern. You wait for a test-performing candle to form, and then you execute your trade on the confirmed break. This disciplined, price-action-based approach removes the guesswork and allows you to trade the market's most reliable signals with confidence.